of course, we appreciate the fact, ladies and gentlemen, that we have got two methods of generating cash flow statements, two methods. We have what we call the direct method. And then number two, we have what we call the indirect method. If you go to an exam and you realize the examiner does not specify the method that you should use to create your cash flow statement, indirect method is always the default. Indirect method is always the default. And if it's indirect method that you would want to use, then this is how you shall start your statement. So indirect method, this is how you shall start your statement. So an indirect method, we always start with the profit before tax. Profit before tax, always. You start with profit before tax. And then you shall come here and do some adjustments. You shall come here and do some adjustments. And how do we do these adjustments? There is what we must cram. There is this acronym that you must cram, the one over dial God's number for food. Dial God's number for food. You dial God's number for food. You dial God's number for who? For food. So the first D here stands for depreciation. Depreciation. This is impairment. Impairment of goodwill. Impairment of goodwill. We have amortization of other. Amortization of other intangible assets. Remember, we have intangible assets, like goodwill is an intangible asset, patents, trademarks. These are all of them intangible assets. But whenever it comes to loss of value of goodwill is normally given a special name. And what is this special name? It's impairment. You call it impairment. But all the other intangible assets, their loss in value will be called who? Amortization. Their loss in value will be called amortization. So amortization of other intangible assets. And then we have here loss on disposal of assets. Loss on disposal of assets. We have here gain on disposal of assets, gain on disposal of assets. And then lastly, we have the interest, the finance cost. Now remember, after this, now the next thing will be for us to think about what here? Working capital changes. So we have here working capital changes, working capital changes. And if you recall very well, if you don't dial God's number for food, then you will be able to rest in peace. And the working capital changes, you always remember, rest in peace. Rest in peace. So we have what we call receivables. We have inventory. We have, in this case here, payables. And then, of course, the moment we capture everything here, we shall be able to get what we call cash from operations. Cash flow from operations. We shall be able to have a figure there of which we shall come and less tax paid. We less tax paid, we less tax paid, like that. And then now lastly, we shall be able to get the net cash flow, from operations. There is a very important thing that I forgot here. Remember, you're looking at cash flow statement, indirect method. And don't forget that this section that we've been dealing with falls under what we call operational cash flows, or cash flow from where? From operations. Cash flow from operations. Remember, we have got a cash flow from 3 key sectors. We have cash flow. You have to distinguish this. We have cash flow from our day-to-day operations, from selling, revenues, cost of sales. So our cash flow from our day-to-day operations, we have our cash flow from investing activities, and then we have cash flow from financing activities. IAS 7 does not allow you to combine those. You must distinguish between the 3 types of what your cash flows. So that at the end of the day, we don't want you to go and raise money from loans, and then you start saying that this money, I'm going to use it to pay dividends. The law does not allow that. The law needs you to pay dividends out of what year? Your cash flow from operations. So if your cash flow from operations are negative, then automatically you should not pay dividends, because the law prohibits us to borrow for purpose of paying owners dividends. If you do that, automatically that will be taken as a bankrupt organization. That will be taken as a bankrupt organization. So up to here, are we together? Up to here, somebody up to here. Are we together? Are we together up to here? Are we together? 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 Great. I can see 2 ladies. Great. So the most important thing, whenever they talk of indirect method and you're looking at cash flow from operations, this is what you shall always think about. This is what you shall always think about. This is what you shall always think about. So then I have a question with me here, which I've shared in your groups, that I would want us to look at. And this is supposed to be exactly, actually, an hour class, 1 hour class. So I'll try my best to move in a speed that everybody should be able to understand. So we are told here the consolidated income statement of Uongozi Limited for the year ended 30th September 2013, together with the comparative consolidated statements of financial position as at 30th September 2013 and 2012 are shown below. Remember, for me to be able to do a cash flow statement, you must give me 2 things. You must give me the current year's income statement. Income statement, I don't need comparatives. Income statement, I'll only pick income statement for the current year. Like here, they have given me the consolidated income statement for 1 year alone, which is here. But for the balance sheet, statement of financial position, I would need comparatives. For the balance sheet, for the statement of financial position, I would need opening balances, which are given here, opening balances, and then I will need the closing, the ones for the current year. So what have I just said? If I were you, I would have written this somewhere there in my mother tongue, that for cash flow statement, I would need income statement for the most current year, the current year. But balance sheet, I would need a balance sheet for the current year together with the previous year's balance sheet, together with the previous year's balance sheet. Without that, I'm not going anywhere. Without that, I will not be able to go to any place. Great. So now, ladies and gentlemen, down here, what have they given me? I'll come very fast and read this. So down here, they have given me something very nice. They have told me there are some additional information here. The cost of sales includes depreciation on property, plant, and equipment amounting to 640 million, and a loss on sale of plant of shillings 100 million. So I can see some things to take there. 3 marks. They are called low-hanging fruits. I will harvest them. I'll harvest them crazily. Intangible assets are stated as follows. I can see goodwill. I can see goodwill. It's jumping crazy. I can see goodwill, right? In 2012, it was 400. 2013 it was 360. Some loss there, some loss there. And then I'm told here, during the year ended 30th September 2013, the holding company acquired a new plant which cost 500 million. The company also revalued its buildings by 400 million. On 1st October 2012, the holding company made a bonus issue of 1 share for every 10 shares held. The issue was financed from the revaluation reserves. Note 3 or 4, the detailed analysis of retained profits as at this year and that year were as follows. So they want me to give them the group statement of cash flows for the year ended 30th September 2013 in conformity with International Accounting Standard IAS 7 statement of cash flows. This examiner never told us to use direct method. He's silent. And whenever he's silent, we shall always, ladies and gentlemen, use the indirect method. We shall always use the indirect method. Great. Now, this is a very basic question. This is not an advanced level question. This is a foundations or intermediate level question. Actually, it should be foundations, right? Because you can see they are cheating us. It's a group question, but there is nowhere they have mentioned anything to do with the acquisition of a subsidiary in the year. And they haven't mentioned anything to do with a disposals in the year. It is a straightforward question. This is a straightforward question. So then how do I pick this? How I will pick this is like this. It's a indirect method. So I'll come and write cash flow from operations. And then I start with profit before what? Tax. Go to the income statement and pick this profit before tax. Go to the income statement and pick this profit before tax. Now that you guys have this question, are you able to read for me these values very fast? So profit before tax, profit before tax. If I look at my income statement, I can see sales, blah, 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 blah. But the one that I would wish to pick here is this profit before tax of 1740, low hanging fruit. I'm in the harvesting season. I'm in the harvesting season. So in this case here, this is 1740. From there, remember the acronym is dial God's number for food. Dial God's number for food. I've been able to pick the profit here. So now I'm on the dial. So the first one, D, is depreciation. Are you able to see the depreciation in this question? Are you able to see the depreciation in this question? Are you able to see the depreciation of the PPE? Are you able to see the depreciation of the PPE in this question? Is there anybody who can see depreciation in this question? Is there anybody who can see depreciation in this question? Oh, yes. I can see the cost of sales include depreciation on property and plant and equipment amounting to 640. It's a low-hanging fruit. I'm harvesting them. I'm harvesting this. So I'm able to see depreciation. So this is 640. This is 640. This is 640. And then they have given me something very important there, loss on disposal of an asset. They have given me loss on disposal of an asset. Are you able to see that loss on disposal of an asset? Loss on sale of plant over 100, over 100. I'm cutting the millions. I'm cutting the millions. I'm cutting the millions. I'm cutting the millions. So loss on disposal, loss on disposal, loss on disposal, loss on disposal is 100. Yeah, loss on disposal is 100. Sorry, I was not seeing, I wasn't seeing this. Good questions there. Good questions there. So like Bruce is asking, why do we consider finance cost in operating activities? You see, listen here. Listen here. Here we have profit before what here, somebody? Before tax. Profit before tax. In this profit before tax, what happened? These guys have adjusted the fact. If you look at this, if you look at this, if you look at this, I can see good questions. How did I forget looking at the questions here? How did I forget looking at the questions here? How did I forget looking at the questions here? Now, you can see this profit before tax is 1740, right? And how they arrive at this profit before tax? by deducting a finance cost. Deducting a finance cost, and I agree with you, Bruce. They should have not deducted that finance cost, because finance cost is not supposed to be under where? Under operations. And that is why we are adding it back to cancel it. We are adding it back to cancel. I don't know whether we are communicating there. We are adding it back so that we can cancel. We are adding it back so that we can cancel. So we have very good students here of data analytics who have attended here, right? Of course, for you, you'll be given an Excel sheet, right? Which you'll be able to use now automatically. These things will be putting them automatically there. But you see, the approach today is that, first of all, I take you through the manual approach. And then come in the next lesson, I should be able to take you, like, even yourself, you'll be able to now post these things in Excel. You should be able to post these things in Excel. And then Charlene has also asked that question. I hope the one who was asking about finance cost, you are satisfied. So Charlene is asking. Yeah, like now you can see Chindoro is posting in Excel. Yeah. Do we consider finance cost paid after cash flow or after working capital? Okay, I know why we have this slight issue there. At the end of the day, it doesn't matter really where you put it. It doesn't matter where you put it. We shall get the same answers. We shall get the same answers. We shall get the same answers. Great, great, great. Now we continue. If you don't mind, let's continue. So I've been able to pick the loss on disposal of assets, right? Now from there, ladies and gentlemen, I'm looking around. What do I want here? I need to come and calculate a few things here now. I would want to calculate this goodwill. I'm not calculating goodwill in cash flows. At your level, nobody will tell you start calculating. No. Ladies and gentlemen, here goodwill for cash flow purposes, I'm only required to look at the loss in value. There was no new subsidiary that was acquired in the year. There were no disposals. At this level, you can't be given those things. So at this level, when I see the goodwill being given, you can see in 2012, goodwill was 400. And in 2013, the goodwill is 360. Is there somebody who is able to see that impairment? Is there somebody who is able to see that impairment? Is there somebody who is able to see goodwill that was impaired? That in this case, ladies and gentlemen, we began, you know, it is always opening minus closing. The opening was 400. We are closing this at the current year 360. So it had a higher value when we began. Now the value is lower. So I'm able to see that loss in goodwill. I'm able to see the impairment in goodwill, which is how much here, somebody, which is 40 bob. Which is 40 bob. Right? If you like the T accounts, I don't like T accounts myself. I only do T accounts for the PPE. If you like T accounts, you can come and do a goodwill account. Goodwill account. So of course, you'll be able to tell us balance brought down. Balance brought down is the balance which came to us from the previous year. So in 2012, we had a balance of 300 and what year somebody, we had a balance of 400, sorry. And then the balance carried down is 360. So come and do your balancing. You do your balancing, 400, 400, then automatically it means that the balancing figure is here, which automatically means what you're lost in value. It's a loss which I'll have to debit my profit and loss with this figure. So automatically this loss in value is what we specially call what here? The impairment. Is what we call the impairment. Is what we call the impairment. But the better approach, especially for the Excel students, it is this: opening minus closing. 21st year given there, the first year given, the oldest year given there is your opening. So opening was 400 minus 360. Please go to the other intangible assets. The other intangible assets, what do we have? For the other intangible assets, this is what the examiner has given us. For the other intangible assets, the examiner has given me these others. You can see we began opening 200. Others, 940. As a bright student of cash flow, when I see this closing being more than the opening, it means that there was an acquisition. It means there was an, so I must throw my eyes broadly to see what is this under other intangible assets that was acquired. Fortunately, even before I throw my eyes far away, I'm able to see down here other intangible assets acquired during the year ended 30th September 2013 amounted to 1,000. So then there is no problem. So if I'm an Excel student, I will take 200, what I began with, plus what was acquired minus closing. Closing must always be subtracted. So I'll talk of 200 plus 1,000 minus 940, minus 940, minus 940. So for the amortization of other intangible assets, so amortization of other intangible assets, what do I have here? Here, can come and put this and they say working, can even put aside, they say working one. So working one, what do we have here? So I know opening minus closing, always it's opening minus closing, and we opened at 200. But before we go to closing, there was an acquisition in between. So plus 1,000 minus closing, which gives me 900. What here, somebody? Closing, which gives me 940. So can somebody in this case here give me this amortized other intangible assets? Can somebody give me a figure? Right? Valerie gives me a figure of 260. 260. If you are a lover of T accounts, if you love T accounts, this is an asset. You can come and mention here, this is an asset. You can come and mention here if you love T accounts. If you love, I hate them. I hate them. Intangible assets, you come and say intangible, it's an asset. So balance comes here. Balance brought down is 200. And then balance carried down. Balance carried down is 940. We had some acquisition. When we acquired, what happened? We credited our bank because money went out and then debited our asset account with 1,000. So in this case here, we have a bank with 1,000 there, right? And then you'll be able to get the balancing figure. So the balancing figure is loss in value, what we are calling amortization. I'll never use this approach myself. I'll never use it. I don't like it. Excel students can't even do T accounts. They can't do a T account in Excel. So are we together first of all up to here? Are we together? Are we together up to here? Are we together? Are we together? Please try to respond. Or am I alone? Are we together? Great, great, great. The fortunate thing is that once I teach you cash flow, just one, not one lesson, today I don't have enough time, like 2 lessons, you guys will become perfect. Will become perfect in cash flow. You'll get 20/20 in a cash flow question without knowing what you are doing. And really, to me, I don't care. The end justifies what are the means, even if it means you cramming. The end is what will justify the means you pass, and then you shall be able to get, as in the advanced level, to teach you these papers now even better. Great. Now, ladies and gentlemen, after that, now we are moving slowly. Now we are moving slowly. We are moving slowly. We are moving slowly. We are moving slowly. So from there, what else am I supposed to think about? I can see loss in disposal of assets that already I have. So chances are I don't have gain. If I have a loss on sale of assets, I don't have that gain. So remember, if I had a gain on, gain on disposal of assets, gain, please I'll assume that we had a gain of X there. Gain is the only one that we deduct out of this. Gain is the only one that we, so if you're told that there was a gain of say 100, I would have put it negative. Gain is the only one that we subtract. So from there, I would want you guys to give me the finance cost, is also known as the interest. The interest you go to straight away to your income statement. So the gain is given up here. The gain is given up, not gain, but finance cost. Finance cost is here. Finance cost is 60. Don't take it as negative. Remember, here everything we are adding apart from the gain. Everything is being added apart from the gain. So then what do we have here? So please come here very fast and give us the finance cost of what here? The finance cost of 60. From there now we go to the working capital changes. So working capital changes, we start with receivables. So receivables, remember, it is OC. It is opening minus closing always. Opening minus closing. So you go to the receivables, you pick the opening figure, go to the receivables, go to the receivables, go to the receivables. So receivables It is here receivables, account receivable. Opening is the older year, 2012 year. So take 1360 minus 1980. 1360 minus 1980. Receivables, 1360. I've forgotten this other figure. Was it 1780? Now this means I'm becoming old. I'm forgetting the closing. I'm forgetting the closing. Is there somebody who can remind me what was the closing? I'm forgetting the closing. 1980. Thank you very much. 1980. 1980. Like that. Now remember. At the advanced level, if, for example, the examiner told you that there was a subsidiary acquired in the year, and this subsidiary came with receivables, I would have taken the opening plus the subsidiary that came in. Receivables of that subsidiary minus receivables of any subsidiary that was disposed. So I'll come back to that later. Can somebody give me this 1360 minus 1980? What figure are we getting? What figure are we getting here? A decrease of 620. Remember, we don't want to reason like that. We don't reason like that because you don't have luxury of time. So long as you take O minus C, if you get a negative there, you write a negative. Don't try even to argue whether it's an increase or a decrease. Don't. Nobody will mark you right or add you an extra mark because of writing those decrease and no. You just take opening minus closing. If the answer is a negative, don't think. Simply write there negative 620. Go to inventory. So inventory, again, it is O minus C. So inventory. So inventory, ladies and gentlemen, what I'm doing here, I'm simply looking for the inventory. So the inventory, what do we have here? Inventory, I can see inventory. Opening is 1880 minus 2940. 1880 minus 2940. Is there somebody who can give me this figure? 1880 minus 2840. Please write. Let me write this. It is 1880. It is 1880. This is 1880. This is 1880 minus. What is the second value? What is the second value there? What is the second value? 2840. 2840. Thank you very much. And I can see I'm Mr. Ndego, a good man indeed, giving me a figure there minus 1,000 or something. Minus 1040 minus 960. Helen tells me minus 960. Minus 960. Thank you very much. And then we go to the payables. So the payables is quite a crazy one. If you are not careful, is it 960 or minus 960, Chindoro? Please be careful. Be careful because under working capital changes, signs are everything to us. And then now we go to the payables. So the payables, what we have here under payables? Under payables, I'll talk of O minus C, but times minus 1. This one is where now many people lose it. You know, payable is a cash outflow. I'll take the opening minus closing, but to signify it's a cash outflow, I must always multiply it with the negative one. If you forget this, it's unfortunate. So opening minus closing times minus 1. Very important. So for the payables, trade payables, are you able to see for trade payables? Are you able to see for trade payables? For trade payables, are you able to see the trade payables here under the liabilities? Under the liabilities, trade payables, under the liability, trade payables, you can see account payable here. So the opening is 1460 minus 1750. So we have here 1460 minus 1460 minus 1750 minus 1750, and then whatever we get, we change the sign. Whatever we get, we change the sign. And then write the figure with the proper sign. Whatever we get, we change the sign by multiplying this with negative 1. By multiplying this with negative 1. We change the sign by multiplying this by negative 1. Write the proper figure. The proper figure, I'm being told that this is 290. I'm being told that this is 290. This is 290. Now from there, of course, we are supposed to come and add, but never add. In a cash flow situation, never add, because you cannot be right. There are very few students who will be able to get this total. You are wasting your time. You just leave. After all, they mark entries. The mark entries, the more the entries you have correctly, the better off you are. So don't go adding nothing. But unless you have Excel, you're adding maramoja. Don't add for you guys. What you need to do is to come and give us here. You just write for them cash flow. Just write there for them cash flow from operating activities. From operating activities. Actually, if I'm the one here, I'll give them an X. And then when I'm feeling, in this case here, that I'm a bit cheeky, if I'm a bit cheeky in an exam, I'll come and draw an emoji, an emoticon, smiling one like that for that examiner there, for the examiner like that. So cash flow from operating activities, and then I'll come and less tax paid. You less tax paid. You less tax paid. So come and less tax paid there. Less tax paid there. So come here and less tax paid. So how do we get our tax paid? You know, if you look at, for example, financial reporting paper is one of those papers that are worst performed by students. Not because they are fools, it's because they do not know how to manage time in their exams. Like I can foresee, even for the data analytics paper, one of those things that students will really not get very well is in time management. If they get a cash flow question, I can foresee some, not of course my students, but I can foresee some of them taking more than 1.5 hours to answer one question. No. It's about moving fast, because at the end of the day, it's about entries. It's about entries, yes. Simplest. Elizabeth is saying simplest. I like that. So less tax paid. So tax paid, I would want a working, but I will never, for tax paid, I will never do a T account. I can't do T account for tax paid, not unless I'm another one. Not unless I'm another one. If I'm another one, I should do a T account. I should do a T account. So for tax paid, I can see I have deferred tax and I've got what your current tax, no problem. So first of all, we handle the deferred tax. So deferred tax, I'll take 280 opening minus closing, yeah? 280 minus 620. 280 minus 620, we combine everything. 280 minus 620. 280 minus 620. So opening minus closing. Plus the current tax. Plus the current tax. Plus the current tax. So current tax, I'm taking what minus what? Current tax, I'm taking what minus what? Is there somebody who is able to see the current tax here? 320 minus 260. So plus 320 minus 260. Plus 320, plus 320, plus 320, minus 260. Is there somebody who can tell me what else am I going to add here? Is there somebody who can remind me what else am I going to add here? What else am I going to add here? What else am I going to add here? Jaylene is asking whether we are required to type. No. From the communication that was given by KASNEB, you are told all this data will be given to you in form of what here? In form of Excel. So yours will be take this box plus this box, this one. Thank you very much. They are telling me in this case here that I need to come and look at the tax paid for the year. The income tax. Go to tax paid. I repeat, go straight away to the income tax expense, income tax expense, income tax expense. Yes, you guys are bright. Income tax expense. So income tax expense, what do we have here? If you look at your income tax expense, you'll be able to see your income tax expense of, please don't take it as minus 540. No. Don't work with these brackets there. No. Here we are adding, because you know, in this tax paid, income tax for the year increases the obligation. It increases the obligation. So plus 540 plus 540. So plus 540 there. Could you kindly give me an answer here for tax paid before I repeat? Before I repeat, is there somebody who can give me the tax that was paid? Is there somebody who can give me the tax that was paid at the end of the year? Is there somebody who can give me the tax that was paid at the end of the year? Valerie Nelima gives me a figure of 260. We need 260. 260. Haka mtu mekachora hapa, wacha tukatoe hapo. less tax paid 260. 260. Where sasa kwa tax paid ukiambiwa na maybe umetoka from this particular room, from this particular room, from this particular room, from this particular class, and then somebody asks you that we saw you in a class being taught by a very bald man who was really shouting. So your spouse now is asking you, what did you understand from today's session? Can you show me how tax paid is computed? So in the simplest language, how will you answer your spouse? Of course, if you understood nothing, you'll tell your spouse, this is none of your business. So I'm waiting to see somebody who would have answered the spouse there very nicely. You tell your spouse, Julius, more like, our is outstanding. We shall overcome, okay? None of your business. Okay, okay. Dial God's forward. We shall overcome, we shall overcome, we shall overcome, we shall overcome, we shall overcome. Now for tax, allow me to repeat, we'll tell her taxes are complicated. Don't talk about tax matters. Tax is a very complicated matter. Get out of my way. Repeat tax. So tax is the easiest. You see, you separate them, you compute them separately. You compute them separately. You compute them separately as KRA. You compute them separately. You see, like, for example, deferred tax. So deferred tax, what do we do? I'll take the deferred tax difference. So deferred tax difference, we are taking deferred tax difference, deferred tax, we are taking here 280 minus 620 plus the current tax difference plus the current tax difference. The current tax difference, what do we have here? We'll take plus 320 minus 260. 320 minus 260. Right? After I get the current tax difference plus the deferred tax difference, I'll come and add the income statement tax for the period. The income statement tax for the period, the income statement tax for the period is 540. Is 540. Give me a minute. I change my batteries, please. Okay. So here we are. For the tax now. For the tax, is there somebody who had a problem who has now been able to see it? Like what I did, I took the deferred tax opening 2012 minus deferred tax closing plus current tax opening minus current tax closing plus the income tax expense for the year. income tax expense for the year. So Sherilyn, have you been able to see it? It's quite an easy thing. Or would you prefer we do a T account? Would you prefer we do a T account? Would you prefer we do a T account? Remember, there are no T accounts in Excel. No T accounts in Excel. No T accounts in Excel. T is easier to understand. I doubt. All the students, you know, I have been an examiner, not an examiner, but an invigilator for so long. Students who keep on doing T account, they waste a lot of time. So as you're moving around, you pass and you see somebody doing very many T accounts. It's only that you can't tell them. It's only that you can't tell them that they're really wasting time. They are wasting time. You can imagine, like, even with the speed that I'm going with, right? I'm yet to finish the first step, but at least now I've finished it. At least now I've finished. So is it possible for you to get your calculator from here? Abracadabra, right? The tax paid, of course, in this case here is negative. Just give me the net cash flow automatically. Give me the net cash flow from operating activities. Of course, there is nothing here. Yeah. So Valerie tells me 1290 after. So you take like 1740 plus. Mali kuna minus, unaweka minus, right? Plus 290. Tax paid, of course, has to be negative. Tax paid 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 has to be negative. Is there someone else who is able to confirm that 1290? Is there somebody else who is able to confirm the 1290 really? Helen has confirmed it. Helen has confirmed it. And even from the answer, you can see it is 1290. It is 1290. It is 1290. It is 1290. Thank you very much. Thank you very much. Great, great, great. So now I can come and wrap this. As I wrap this from operations, what is it that you can never forget out of this exercise when they tell you to calculate cash flow from operations? What is it that you guys can never forget? The acronym, isn't it? The acronym. If you forget the acronym, then you are done. Then you are done. If you forget the acronym, you are done. If you forget the acronym, you are done. Now from there, we go to the second section, which is cash flow. Cash flow from investing activities. So cash flow from investing activities. Yes. Depreciation of 640, it was given in the question, Eunice. It was given in the question. It was given in the question. It was given in the question. Depreciation is given here in this question. Depreciation is given here in this question. Depreciation is given in the question. It's here. Oh, this thing is jumping quite a lot. Depreciation is given in the question. Depreciation is given in the question. Depreciation is given in the question. It's here. Depreciation on a property, plant, and equipment. 640. Even the loss is given. Now we are looking at cash flow from investing activities. So when they talk of cash flow from investing activities, what comes to your mind? Hey, you good students. Investing. What comes to your mind? Here. We invest in non-current assets. 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 So for property, plant, and the equipment, you will have PPE that was acquired, and there could be PPE that you sold. So for PPE, I don't even have to be told by anybody. I'll come and write. I'll come and write here. PPE purchased. PPE purchased. Just write like that. Right. Then we have here PPE sold. I'm looking at the proceeds received. All right. Disposal, I like that. Disposal and acquisitions, I like that. Disposal and acquisitions, I like that. So then you just read the question. And then of course here, I'll also have something on intangible assets. I'll have something on intangible assets. Right. Right. All right. So ladies and gentlemen, please listen and listen to me very well. Listen and listen to me very well. Whenever they talk of investing activities, don't look far away from here. Look at the items here. I have invested in PPE. I have intangible assets. I have an associate. Any investment that I make in an associate, I expect dividends. So I'll have something to do with the dividends received from the associate. Dividends received from the associate. Ladies and gentlemen, please listen and listen to me very well. When you look at this property, plant, and equipment, what have they told us really here? What have they told us really here? What have they told us really here? They have told us something very nice. I love cash flow. An examiner who brings cash flow question is an examiner who is wishing me success. Is an examiner who is wishing me success. Like if you read here, they have told us the cost of sales includes depreciation on property, plant, and equipment amounting to 640 and a loss on sale of plant of 100. First of all, leave that out. Other intangible assets during the year ended 30th September 2013 amounted to 1 million. You can see we acquired some intangible asset. This could have been like trademarks acquired. So I can see in this case here, intangible assets that were acquired. So I can see intangible assets, ladies and gentlemen, here that were done what here? I can see intangible assets here that were acquired. This is cash flow. We paid cash. We debited, in this case here, our intangible asset and credited our bank account. So in this case, I'll come straight away and mention their purchase of intangible assets, free mark, low-hanging fruits. So purchase of intangible assets, 1,000. Purchase of intangible assets. Purchase of intangible assets, 1,000. Purchase of intangible assets, 1,000. Purchase of intangible assets, 1,000. All right. I'm putting this in brackets simply because of what here, you know, intangible asset came, money left. Money left. Intangible asset came, money left. It's a cash outflow. It's a cash outflow. It's a cash outflow. It's a cash outflow. All right. What else are they telling us, ladies and gentlemen, here? Let's just check this closely. Let's check this closely. Let's check this closely. You have to be very bright here whenever you are handling this kind of questions here. You must be very bright. If you're not bright, you'll not be able to really get much. Now, when you read this next statement, during the year ended 30th September 2013, the holding company acquired a new plant. This is PPE acquired. So acquired, so PPE was purchased here. Acquired a new plant costing 500. So where I have your property, plant, and equipment purchased or acquired, I'll come and put 500 here. I'll come and put 500 in brackets like that. All right. Now from there to get the proceeds now from PPE sold, this one now from my experience, I know for PPE, most students here would prefer what here? Most students here would prefer a T account. So PPE. Remember, whenever you're doing a T account, you must remember our acronym of PALS. PALS. If you remember this acronym of debiting and crediting, that purchases, expenses, assets, whenever they increase, debit. Debit. Purchases, expenses, assets, whenever they increase, debit. On the credit side, we have revenues, liabilities, and share capital. So like when we go to the next thing of financing, you will see us talking of share capital. Share capital account will be, balance brought down will be on the credit side. These ones, balance brought down, like these are assets, we must bring the balance down here on the debit side. So balance brought down. Is there somebody who is able to see the balance brought down here? Is there somebody who is able to see the balance brought down for the PPE? Is there anybody who is able to see the balance brought down for the PPE? For the PPE, these guys are not even talking to me. I don't know why. For the PPE, is there anybody who is able to see? Is there anybody who is able to see the PPE balance brought down? These guys are not talking. They're not nice. No, I'm joking. Nice. Property, plant and equipment. Balance brought down in ngapi? Balance brought down in ngapi ya PPE woye? Balance brought down ya PPE ni ngapi woye? Woye niambieni balance brought down. Aki usikasema ati 3780. 3780 aki hiyo ni balance carried down. The brought down here was 3660. The brought down was 3660. The brought down was 3660. The brought down was 3660. Brought down was 3660. And then now the other year, we talk about balance, which was carried down. Who can give me this balance carried down? The most recent year, the one that you're taking to the future. The balance carried down gives us what figure? Somebody balance carried down. The balance carried down gives us what figure? 37. It's only Helen who is talking to me. I don't know why. It's only Helen who is talking to me. 3780. Now, according to payouts, whenever we acquire an asset, what do? We debit. We know that in the year, there was an acquisition here. We acquired. So we acquired. So you can talk of PPE acquired. PPE acquired. Bank. How much? 500. 500. We did revalue our assets upwards. We did revalue our assets upwards. This is it. This mouse is not the best, sorry. So they're telling us here that the company also revalued its buildings by 400 million. They never told us whether it was revalued downwards or, of course, you know, you guys are financial reporters. Whenever they tell you that the revaluation was 400 and they're silent, it's only prudent for you to assume that the revaluation is upward. And of course, whenever our assets increase, what do? We debit. So revaluation. So revaluation 400. And then if you remember very well, there is a place where they told us, that we had a loss on sale. We had a loss on sale of some asset. We had a loss on sale of some asset. Do you remember? Do you remember that loss? There's a place they told us something like that. There's a place they told us something like that. There's a place they told us something like that. They told us somewhere. They told us somewhere. There is a place they told us. Yeah. And a loss on sale of plant of shillings, what here? Somebody 100. So meaning that we had some disposals. Meaning, ladies and gentlemen, that we had what here? We had some disposal. So remember, whenever you have a disposal of asset, that means that the property, plant and equipment value is going down. So you must come and give us the disposal here. And this is normally done at net book value. So could you kindly give me this disposal? Could you kindly give me the bigger? I think this side will be bigger. I'm hoping this side will be bigger. But 660 plus 500 plus 400 gives me what figure? Somebody gives me what figure? Somebody at 660 plus 500 plus 400 will give me what figure? Somebody 4560, yeah? 4560. And then this, of course, is 4560. So then could you kindly give me the disposal net book value? The net book value now will be this minus this figure, this minus this figure. What figure are we getting here, somebody? What figure are we getting here, somebody? According to Helen, this should be 780. According to Helen, this should be 780. 780. 780. I've done quite a lot of talking without really recording. I forgot to return back to recording. What basically we're doing here is this property, plant and equipment account. So we have the balances, we have what plant was acquired, we revalued upwards 400. So the balance carried down was 3780, which we were able to balance using this bigger figure, 4560, which helped us to get this disposal of 780. Now, these disposals of 780 is not cash. Very many students will tell you that this disposal is what you bring here. No, this is not cash. This is net book value. So I'll need to open a disposals account. Here, I credited this PPE account. Now I need to transfer the PPE, which was disposed. I transfer it and put it here. So PPE is 780 here. And then now remember, disposals will help us to either get a loss or a profit on disposal. If it's a loss, like in this question, we had a loss, we made a loss of 100. So whenever you make a loss, what happens? You credit the disposals account and then you debit the profit and loss account. So in this case here, we shall come and credit this account with 100. So then could you kindly, in this case here, go ahead and do the balancing. So when you do the balancing, what do we have, ladies and gentlemen? When you do the balancing, we have 780 here, 780 here, we have 780 here, we have 780 here. And then of course we have 780 here as well, 780 here as well, 780 there as well. So in this case here, of course, it means that out of whatever we disposed, we received how much in form of cash. We received how much in form of cash? 680. This is what we received, 680. So we credit this account, we debit bank, and then we bring this to the cash flow statement. And mention here, PPE is 680 positive. 680 positive. That's what we received. That's what we received. That's what we received out of this. So normally, the property, plant, and equipment account is not something that so many guys like. Although I have a shortcut, especially with the students of Excel, I'll be sharing with you that shortcut. The AFR students should be able to do it the longer way like this. I don't want arguments. Now I'm tired. Now I don't want arguments. Let's first of all, for the AFR students, they just have to appreciate this. These are how they were taught. But for the Excel students, when I meet you tomorrow, because tomorrow we're not combining you, I should be able to show you the shortcut. I should be able to show you the shortcut. Great, great. Now, ladies and gentlemen, here we are. So then what do we have? If you look at this question very well, remember, you are looking at investing activities. Under investing activities, what are you thinking about, you bright student? Under investment activity, you are thinking about PPE, which of course will have an acquisition and a disposal. Intangible assets already have been able to handle this. Then I have an associate. So for this associate, what do I need? I need to calculate the dividends from the associate. This is the easiest thing ever. This is the easiest thing ever. Is there somebody who can calculate the dividend for me? Is there somebody who can calculate the dividend for me? Is there somebody who can calculate the dividend for me there? Is there somebody who can calculate the dividend for me? The dividend from the associate. The dividend from the associate. Nobody wants to talk to me. Nobody wants to talk to me. There's nobody who wants to talk to me. There is nobody who wants to talk to me. Dividend from the associate. Dividend from the associate. Dividend from the associate. Very easy. If you love the T account, then you'll come and do an investment in associate. You will come and do an investment in associate. You'll come here and do an investment in associate. So give us investment in associate. Investment in associate. This is an asset for you. So please give us the balance brought down here. Give us the balance brought down. Are you able to give us the balance brought down here, somebody? Are you able to give us the balance brought down? Are you able to give us the balance brought down? Oh, are you able to give us 160? Thank you very much. How about balance carried down? How about balance carried down? How about balance carried down? Balance carried down. How about balance carried down? 190, 190. Now from there, you go and ask yourselves whether you have any income from the profit and loss associated with your associate. From your profit and loss, from your income statement. From your income statement, do you have, from your income statement, are you able to see any income that came to you in the period from your associate? From your associate, you can see group share of associate profit after tax. Are you able to see this figure? Where are they calling it 80? Am I the one? Am I the one who is not seeing it? Is it 80? Valerie, just check again. Perhaps you're looking at different things. Right? Group share of associate profit after tax is 40, is 40, is 40, is 40. Let's agree. Is it not? It must be 40. So that, of course, is increasing your investment. Is increasing your investment. So we have here profit and loss 40. If that is the case, then, ladies and gentlemen, I'll come on the balance. Investment in associate ena maneno. Unasema 200, 200. The balance must be dividend received. Dividend paid by the associate, but you received it yourself. You received it yourself. You received it yourself. So what is the dividend received, ladies and gentlemen? What is the dividend received here? What is the dividend received here? What is the dividend received from the associate? They're not talking to me, and yet we are almost finishing here. 10, eh? Dividend received from the associate is 10. So it's an investment. So mention there dividend received. Dividend received. Dividend received from associate. And then I can see a good student asking a very good question there. Dividend received from associate is 10. Dividend received from there, it's positive, 10. Then I can see a student asking, how comes we never deduct under operating activities? Okay. Okay. How comes we never deducted depreciation from PPE? Are you sure we never? That's why I hate T accounts. You want to tell me that we forgot depreciation? Because depreciation reduces the value. Depreciation reduces the value. We must be very stupid people. If we forgot depreciation, we must be stupid people. We must be stupid people, all of us, including Mwalimu. Very stupid. No, let's be easy on ourselves. Let's be easy on ourselves. So then go to your T account, ladies and gentlemen. That's why I don't like T accounts at all. In your T account, where should we put depreciation? PPE. Go to your PPE T account. Where should we put depreciation? Where should we put depreciation? Credit, credit, because it's loss of value. Sorry for that. I'm so sorry. So please, as you write this, be cursing me. Be cursing me. Be cursing me, because I'm the one who was messed up with your books. Please be cursing to me. Be cursing me. Be cursing me. So depreciation, depreciation, depreciation over how much? What is the depreciation for property, plant, and equipment? Already we have this figure. Already we have this figure. I'm so sorry. Already we have this figure of 640. Sorry for that. 640. So it means that this disposals figure is wrong. Could you kindly rub this disposals figure? It means that the disposals figure is wrong. So say 4560 minus 3780 minus 640. Give me the disposal figure, correct figure. Give me the disposal figure. 4560 minus this minus this. As you do that, I'm so sure you are very angry, but just curse me. I've allowed you to curse me. Curse me to have like 10 children. 10 children. Nothing less than that. 140. 140, 140, 140, 140. So then once you get these disposals, could you kindly come here to your disposal? Do you remember your disposal account? Do you remember your disposals account? Are you able to pass that entry in the disposals account? And then you give me the amount that I expect to receive. Somebody please, Is there somebody who can go to the disposals account? Let me go to the disposals account. Let me put up this disposals account. Let me put up this disposals account. Let me put up this disposals account. Disposals account. So in this disposals account, so remember now here we are bringing 140 PPE. And then the loss itself was 100. So meaning that the bank will be how much here, somebody? 40, which gives us 140 there, 140 there. So under PPE proceeds, please just grab this, and then you put 40 there. Grab that, and then you put 40 there. And that is it. We have now exhausted everything to do with what here? Cash flow from investing activities. Cash flow from investing activities. Now we are complete. Is there somebody who can give me the total there? Cash flow from investing activities. Is there somebody who can give me the total there? Is there somebody who can give me the total there? Is there somebody who can give me the total there? Cash flow from investing activities. Is there somebody who can give me the total? There's some good student should be able to give me the total. Some good student should be able to give me the total. Now that they're not talking to me, what should we do? Yeah, 1450 negative. 1450 negative. Thank you very much. 1450 negative. 1450 negative. Great, great. Now from there, mention cash flow from financing activities. Cash flow from financing activities. Why are you not deducting share of profit of associate under operating activity? Have you done this topic in class? Have you done this topic in class? Now, if you get yourself subtracting share of profit after tax, it means that your teacher was starting from here, profit for the period. So you start from profit for the period, then you have to look at all these things. You know, here I began from profit before tax. So I'm looking upwards to know what to deduct. This 1740 figure does not have this 40 in it. Can you subtract something which is not there really? I don't know whether you are communicating here. The 40 is not within 1740, right? It's not within 1740, right? I would have only deducted it if, for example, I began with, from me a profit for the 1240. So maybe I would have gone ahead and said minus 40. I add back this. And that is why I told you from the word go, always ensure that you begin from profit before tax. Just check what your teacher taught you. I'm so sure if your teacher was subtracting this profit from the associate, this teacher must have begun with this figure, which is still okay, although yours will be a bit longer. Yours will be a bit longer.